Hello everyone, welcome to chapter 9. This chapter is going to be about market structure and how we're going to use market structure to build a narrative and gain insights to the market dynamics. Now, this is one of the most underrated concepts and it's quite overlooked by the ICT and CRT community. And in this video, I'm going to make sure to explain everything about market structure, its advantages, disadvantages, and the correct way of using it to probe and measure order flow. I'll also be giving you some important points regarding basic and advanced market structure that you need to be aware of when using it in your analysis. I'll be explaining both basic and advanced market structure and will differentiate between the two, and then I'll give you a framework for how you can correctly identify and use market structure in a proper way and manner. I'll also provide you with the time frame that you should be looking for market structure, both as an intraday trader or as a swing trader. So let's move on to the chapter. So first of all, we're going to start off with introducing what market structure is and what are its key elements and how you're going to be dealing with it, right? So the framework within which price movement occurs is called basically market structure. Now we're going to objectively define that framework and we're going to discuss how you're going to approach that framework logically. So basically, when you look at the charts and see price with a naked eye and without any annotation whatsoever, you may have conflicting ideas about it, right? And it may seem a bit ambiguous. But then as you start analyzing it with the concept that we've discussed so far in CPI, you're gonna see that it starts to make sense, and you'll then get a range to work with, right? And a framework to work with, and price would be stuck in that range and framework, right? Now for that range of framework of price, you're going to use market structure to deal with it, right? And to approach that framework properly. That particular framework of price within which market movement occur is called market structure. Moving on. Now, the key elements of basic market structure are just simple highs and lows, right? We know that the markets are made up of multiple and various types of highs and lows. And it's actually these highs and lows which makes up the whole market and defines their structure. Now there are multiple methods to approach these highs and lows, and that will define your type of market structure and your position as an analyst, right? If you approach it basically with just highs and lows and define and generate opportunities or trade idea based off of that, then that means you're using basic market structure. But if you're using advanced methods to approach those highs and lows with a more logical and slightly more objective framework, then you're going to be approaching that particular framework with a more enhanced perspective. And that means that you're using advanced market structure, right? So the basic and key elements for market structure doesn't matter whatever type of firm it is, it's just simple highs and lows or swing points. These three things are the main things that make up market structure, right? It doesn't matter whatever form or type it is, right? These three things, highs, lows, and swing points, make up market structure. Now, another thing about market structure is that it's inherently quite subjective in its core concept, right? Because highs and low can have multiple forms and they can be defined in multiple and various manners. So due to that fact, market structure can be quite subjective and ambiguous at times, right? But there are certain ways with which you can make it a bit more objective and logical around its framework, and I'm going to show you in that way. I'm going to show you that in this video. So due to the fact that market structure is inherently subjective, that's why market structure would be only be used as a confluence for pre-existing ideas or pre-existing frameworks, right? Which means you must never use it as a main basis. You should never start analyzing the charts with market structure. And that's the exact reason why I explained market structure to you later in CPI, because I didn't want you to approach it as something that could be used to define the charts and defines trade ideas predominantly, right? I didn't want you to have that perception about market structure. That's why I explained it later to you in CPI, because I want to give it to you as something that could be used as a confluence rather than as the main basis. So you should be only using market structure for previously existing ideas and frameworks, right? And only use it there as a confluence to either gain more conviction in your analysis or to assist you in your analysis, right? And you could also use it to classify different ideas in terms of their probabilities. So for example, if you've got a pre-existing idea and it's a bullish trade idea, right, and then you analyze the charts with market structure and you see that the structure is bullish, then you could classify that particular idea as a high probability idea. Whereas if you have a bullish idea or a trade idea that is in the bullish side, right, or a long trade idea, and then you analyze the charts with market structure and the market structure is actually showing you that price is bearish, then you could classify that trade idea as either an average probability trade idea or a lower probability trade idea, right? That's how you classify different ideas in terms of their probabilities with the help of market structure. So to summarize market structure and its introduction, first of all, it's a framework within which market movements occur. Secondly, its key elements are highs and lows and swing points. And last but not least, it is used as a confluence rather than a main predominant basis. Alright, let's move on to the next slide. So first of all, we're going to start off with basic market structure, right? Now, basic market structure is something that I only used in my initial stages of my journey, right? And I've stopped using it. But the reason why I'm going to explain it to you here is because it's going to build your basics and fundamentals, right, surrounding market structure. And as we move on to its advanced prototypes and protocols, you'll be able to understand those parts better and easily if you are aware of its basics, right? And it stays true for any other thing or every other field. Even though we know that we're not gonna use a basic concept or a basic theory for making money or making business decision, but we still learn them at first because we know that in order to move on to the next level and reach that next level, right, or to become more advanced and more competent, we have to first build our basics and fundamental understanding. And that's why it's necessary for you to be aware of its basics, right? Even if you think that you've learned it before, right, it will be completely worth it for you. So as I said before, the main and key elements for basic market structure are highs and lows, right? It's basically what is it made of. Second thing is that it should only be used as a confluence, right? As I said before, and not as the main basis for generating or defining trade ideas or frameworks. Third thing is that basic market structure is not that significant in its core concept inherently, but it's good to be aware of to build your subconscious biases, right, and subconscious ideas surrounding price when you're dealing with it. Now remember, I'm talking about basic market structure here, right, and not the advanced one. So remember, there's a difference between the two, and we're going to explain the advanced market structure once we go through this one right here. Moving on, in basic market structure, we've got three types of market structure, right? We've got the uptrend, the downtrend, and last but not least, we've got the range, right? Now we're gonna move on and we're gonna see how each of that structure is made up of, right? And what is the combination of each of that structure, and what is the combination of highs and lows, right? Some of you might be aware of it, but it's good to revise. So let's move on. So right here we've got an uptrend, right? There are multiple names to it. You can call it a bullish trend, a bull trend, or anything you want, right? But the idea is that uptrend is made up of highs and lows, which consistently moves higher, right? Just as the name suggests. Right here you can see that we start off with a low, and then what happens is that price continues moving higher and makes a high. Now that price is made a high, it has to first retrace back before it's move higher again. So when it forms this retracement right here and then it ends it, that retracement forms a higher low, meaning a low that is higher than the previous low, as you can see, right? That is how we define a bullish market structure in an uptrend. Similarly, when price keeps moving higher again, it eventually makes or forms or produces another high, which is higher than the previous high, price had made earlier, which is why we call this type of high as a higher high. And that framework continues and price keep making these higher highs and higher lows until a higher time frame objective or drawn liquidity is met, right? This is how we define an uptrend in its core concept, right? This is just basic knowledge. Now let's move on and define the second structure, which is a downtrend. So a downtrend or a bearish market structure starts with a high, and then what happens is that price moves lower and makes a low. Then after that low, we have a pullback or a retracement, right? Before we can continue moving lower again, right? That retracement, right, after price makes a low, forms another high, which is lower than the previous high, which is why we call this type of high a lower high. This lower high represents that the structure is bearish, right? Similarly, we form another low which is lower than the low it previously formed, which is why we call this particular low a lower low. And then price continues that framework of this bearish market structure. This is what we call a downtrend. Moving on. And again, last but not least, we've got a range, which is another type of market structure, and it's a bit more advanced and has much more details. But the core concept is that when price forms two significant points, right, in the form of a high and a low, and then price is stuck between that high and low, and it isn't able to break above or below that high and low, right, or those swing points, and it doesn't show any signs of a trend or momentum, that type of structure is what we deem as a range, right? Now range has a lot of more details and there are different intricacies to it and how you could trade it, right? And I'm going to be making a separate chapter on it too, discussing everything about range, right? And how does it look and how it works on a basic and minor level, and how you could approach it on a much more advanced level and how you can trade it, right? I'm going to be making a separate chapter on it in later levels of CPI. So yeah, okay. So moving on, now that we've discussed basic market structure, we're going to move on to advanced market structure, and that is going to be our predominant focus in this chapter. I'm going to be showing you how is it an advanced version of structure and how you're going to be using its detail and intricacies to deal with price in different situations. So this type of market structure provides a more refined and accurate perspective of price and how you're going to be approaching it. This type of market structure or advanced market structure considers breaking and rejecting of highs and lows. Now we're going to discuss what each of them means in just a minute, but that's what it's specifically based around, right? Breaking of highs and lows and the rejecting or rejection of highs and lows. Another important thing about advanced market structure is that it integrates or combines other important and critical methods with which you can gauge, measure, or probe market order flow or structure. And the thing about those methods is that they are based around practical concepts that actually relates to price, and you're going to be able to see them on the charts in a logical fashion, unlike basic market structure, which is based around unrealistic theory and which you won't ever see on the charts, and they're just cherry picked, right? Basic market structure is just to build a fundamental understanding, right? But the thing about that is that when you look at the chart and price, they never look like that, right? The underlying concept is going to be there, but it'll never look clean and sweet to you like that as I shown you in the images before, right? But with this type of structure, advanced market structure, the framework and ideas that I will discuss with you in this chapter, you're going to see that perfectly on the charts when you combine it with the other concepts, right? And you would be able to classify price action into different structure easily, right? And simply based on objective rules and criteria that I'll give you in this chapter. Now let's move on to the next slide and let's discuss the different methods, right? So first one we've got here is the breaking and rejection or rejecting of highs and lows, right? Now if you go on the charts and use these exact concepts and criteria, then you're going to see that this is exactly how price moves. But remember what I said before, you must never ever use these concepts alone or as something to define an idea in the first place, right? It should only be used as a confluence or as a second hand when you've already developed frameworks or trading ideas, right? So you must remember that. Now let's define an uptrend or a downtrend based on this. So when price is consistently breaking above highs and rejecting below lows, which means that price is only able to break above highs when it, right? And when it comes to lows, it's only able to reject them and unable to displace below those lows, right? Then this type of structure is what we deem as an uptrend. And this right here is refined and as close to real structure as it gets, right? It's the most refined definition for an uptrend or a bullish market structure that I could find. Now, by breaking above highs, I mean that price is consistently closing above highs and is and having proper displacement and expansions above highs, right? And it is consistently making higher highs, right? Which defines a bullish market structure. And by rejecting or rejection of lows, I don't mean that it's not able to close below it or price isn't able to go below it, right? It definitely can, and it does oftentimes in this type of structure. But what happens is that these closes, right, or these moves below these lows are often faded, and price reacts from there and goes higher immediately. And the reason why it does and it forms these rejection below lows is to manipulate traders into thinking that the structure is shifted when in reality it hasn't, and the only thing that it's doing is rejecting or rejection below these lows, right, to take out liquidity. Rejection could also come in the form of price closing below too, but then what happens is that price immediately goes above without staying there for a large amount of time. That's what we call rejecting below lows or rejection of lows, right? Similarly, for a downtrend, it's classified when price is consistently breaking below lows and rejecting above highs, meaning it's unable to go or have a displacement or expansion above highs, which is what we call rejecting above highs, and predominantly it's only able to expand lower below lows by breaking them and closing below them, right? This is how we classify a bearish market structure: breaking below lows and rejecting above highs. Now let's move on to the next slide and see how each one of them would look. So right here we've got an uptrend or a bullish trend, which means that our drawn liquidity is higher, or that we've done our analysis and everything, and we know that our objective is to move higher to reach the drawn liquidity which is higher, basically, right? So right here you can see that we've got these highs and lows right here, right? And what you can see in this price action is that the price is in a bullish trend, and it's pretty obvious because it's making consistent higher highs and it's breaking above old highs to make new highs, right? But if you zoom into this price action right here, then you'd see that price actually went below this low right here, and maybe it even closed below this low, right? Now, if you were looking at this price action with a typical or basic market structure, then you wouldn't, then you would have inaccurately and wrongly classified this as a change in structure, right? But because you're using advanced structure and you're using logical framework, you know that this move below this low is just to manipulate retail traders, and this is just a rejection below this low, right, to rebalance the whole range. And you would know that it's pretty common for uptrends. So with this in mind, you wouldn't have gotten scared by this reaction, but instead you would have approached it and traded it, because you know that this is just a counter reaction to take out retail traders or take out liquidity. Whereas we are looking at it, right, take out liquidity, right? That's how you look at this price action with a refined perspective, and you're going to approach it with a logical perspective, right? This is what we call rejection of lows. This is exactly what happened even here. We got below this low, but eventually we expanded above to break the high to make a new high called higher high, and we continue that trend towards return liquidity. So you can see right here, this is how price moves in a bullish trend. It reject below lows and it break above highs, right? If you go on and practice this exact thought process, then you'd see that more often than not, this is exactly how price generally moves. Now let's move on and see how does a bearish trend looks. Again, right here you can see that the drawn liquidity or the higher time frame objective is lower, right? And what happens is that price starts this journey and start making these highs and lows. But the reaction to these highs and lows aren't typical, right? You can see that price is moving logically by breaking below lows consistently. But not only that, price is also taking out counter liquidity in the form of rejecting above highs and manipulating out retail or basic traders, right? This is how a bearish advanced market structure looks. Price break below lows and reject above highs by taking out liquidity. This rejection could come even in the form of closing above it. But what happens is that price isn't able to stay there for a long amount of times, and that rejection is short-lived. This is how we classify a rejection, right? Now we're going to move on to the next slide, and we're going to add another filter to market structure, and we're going to make it even more advanced, right? So in basic market structure, we only have highs and lows, right? And higher highs or higher lows, or lower highs or lower lows, right? But when it comes to advanced market structure, we also include short-term swing points or intermediate-term swing points. We have another one which is called long-term swing points, but that's not a topic for now. You can only deal with the short-term swing points and intermediate-term swing points, and that would be more than enough for you. So inside short-term swing points, we've got short-term highs and lows, a short-term high and short-term lows. And with the intermediate swing points, we've got intermediate-term lows and intermediate-term highs, right? Now we're gonna accurately define what each of them means and how we can classify them. But you need to remember that these are the main aspects and key elements which makes up advanced market structure. So right here we've got a bullish trend or an uptrend, and our drawn liquidity is higher, right? That's a framework we're working with. So we learned that in an uptrend we break above highs and we reject below lows. That's how we accurately define and objectively classify market structure into an uptrend precisely, right? So what you need to know is that that each high and low price forms will be called or classified as a short-term high or a short-term low. It doesn't matter whatever high or low is it, every single high or low that price forms will be considered a short-term high or either a short-term low, right? So for instance, this low right here is a short-term low and that high is a short-term high, which means every high and low you see is either a short-term low or a short-term high. If it's a high, then it's a short-term high, but if it's a low, then it's a short-term low, right? So that's basically how we classify short-term highs and short-term lows. It's pretty basic, right? The way how it gets advanced is when we add intermediate term swing points or intermediate term highs and intermediate term lows. And there's a unique way to classify these highs and lows, right? So we know that in an uptrend we reject below lows, but those rejections are pretty dim, right? Meaning they are short-lived and price expands above quite immediately after that happens, right?
So when price rejects below a low and then it expands above, it forms a low there, which will be regarded as a short-term low as well. But then what happens is that price retraces back and form another short-term low to the right of that short-term low that we had formed earlier after rejecting below that other short-term low, right? This one. Do you understand what I mean? Let me say it again. First of all, we form this short-term low, right? And then price comes down again and reject below this particular short-term low and have this rejection right here. And after this rejection, we form this new low right here, right? Now this low will be also regarded and considered as a short-term low. But then what happens is that price expands above and it retraces back. And now that it retraces back again, it forms another short-term low. So now you can see that this short-term low right here has two short-term lows to its opposite side. The first one it has is to the left, which it rejected below, right? So we've got this short-term low, price rejected below this short-term low, and then we've got another short-term low which form after the retracement. So due to this low will now be regarded as an intermediate term low, right? you can see it to the opposite side of this short-term low that we formed after this rejection. We've got two short-term lows, and now this short-term low is going to be classified as an intermediate-term low because it's a unique one. First of all, it formed after a rejection below a low, below this low, and second of all, we've got not one but two short-term lows to its opposite side, right? One to its left and one to its right. So for that reason, this low would be regarded as an intermediate term low, right? Now, the unique and important thing about this intermediate term low is that this low is what we also call a protected low. You may have heard me or Romeo talk about protected lows in high, right? And you might have second guessed yourself wondering what the fuck we are actually talking about, right? And if you didn't know the answer, then this right here is exactly the answer to that and how we classify protected highs and lows, right? A protected low or an intermediate term low or a protected high or intermediate term high are basically swing points which forms after rejection below highs and lows, right? And either bullish trend or bearish trend, right? And they've got two short-term highs and lows to its opposite side, right? And that is why we call these type of short-term highs and lows intermediate term lows or highs, right? And right here you can see that this protected low which formed after the rejection below this low and this bullish trend, right? And now we've got two short-term lows to its opposite sides, and that is why we consider this particular low as an intermediate term low. And this is the exact low, right, that could be used for two main purposes. It could be used for placing your stop loss, and it can even be used for invalidation areas, meaning areas where your idea or potential idea is invalidated, right? And you're going to ditch that idea if price goes below that low because now price is showing you weak signs, right? This is how we classify short-term highs and lows and intermediate-term highs and lows, right? Another thing about this is that rejection below lows in an uptrend only occurs below short-term lows and never below intermediate-term lows, because intermediate-term lows are always protected and you'd never see price go below an intermediate-term low in an uptrend. It is only able to go below a short-term low, right? These are some of the important points regarding short-term swing points and intermediate-term swing points. Similarly, if you are looking for liquidity to be taken out and you want to see where could the turtle soup occur, or the purge of the liquidity or rejection of the lows occur, then for that you should be looking for short-term lows and not intermediate-term lows, right? Remember that. Last but not least, you can see the price breaks above highs in a typical fashion and continues the uptrend. Now let's move on and let's define intermediate term highs and short-term highs and short-term lows in a downtrend. So right here again you can see that price is consistently breaking below lows and rejecting above highs and is moving towards the higher time frame objective or drawn liquidity. We know that each of these highs and lows are basically classified as short-term highs and lows without any confusions or doubts whatsoever, right? Now the way how we classify an intermediate term high is through the following manner. We wait for a short-term high to be rejected, meaning we look for price to reject or go above that short-term high to take out liquidity. And then once price does that and it expands lower again and forms that new short-term high after that rejection, we wait for a retracement and wait for another short-term high to be formed to its right. And once that short-term high is formed and produced, that other short-term high that was formed after the rejection of the short-term high to the left is now classified as an intermediate-term high. And that high would be an important level for price because it can be used as an invalidation area. And most of all, that high would be protected at most of the time, right? And price usually never takes that high out unless and until the drawn liquidity is met and the objective of the higher time frame is reached, right? If you need to rewatch this video, then make sure to rewatch it again because this one has got some really good details that you can make notes of. Now we're going to move on to the next slide and we're going to discuss how we can identify correct, logical and proper structural shifts, right? Now we know that market structure shifts is a weak and incorrect and improper concept, right? And it never works the way how you've used it, right? Typically. But at the same time, we have to define and know how we can correctly identify and classify an advanced structure shift. It's going to be different from the typical that you know of, right? And that you've heard of is going to be different than that. And I'm going to discuss this in this chapter. Before we do that, we've got some prerequisite and requirements for structure shifts, right? Because just as I said before, you would not be using advanced market structure alone, but you're going to be using it rather as a confluence for the pre-existing concepts and ideas, right? The same manner you're going to be using the concept right here only in conjunction and integration with other concepts and profiles, and only then you'd be able to identify correct structural shifts, right, accurately. So the main important prerequisite for structural shifts are the following. First of all, you need to be in line and in sync with the higher time frame drawn liquidity, and you must never trade against it, right? That's what you need to remember first of all. Another thing is that you would only be classifying and defining and finding structural shifts only if they occur at a higher time frame key levels, right? Write that down. If they haven't been formed at a key level and a higher time frame key level, then fuck it. Don't classify that as a correct one, because a higher time frame key level is a must for this concept right here. Similarly, the most accurate, precise, and significant shifts and changes occur during key times in macro. For example, they occur during important days or during kill zones, right? So this is also an aspect you could add to your arsenal when looking for shifts at key times at higher time frame key levels, right? And only in the direction of the higher time frame drawn liquidity. These are the prerequisites that must be followed, otherwise you'll be inaccurate and imprecise. Now moving on to the next slide, let's discuss how we can confirm a bearish structure shift while using all of the concepts in conjunction with the advanced market structure. So what you're going to look for is you're going to wait for the low that breaks the high and leads price to a test a key level to be broken. And once that particular low is broken, the structure changes and it shifts to bearish. Now again, this only stands true if price tests the higher time frame key level and then the next higher time frame objective or drawn liquidity is lower, right? And the shift happens at a key time. When the low that breaks the high gets broken, it's result in a correct structural shift. And let's see how it would look. So right here you can see that first of all we are on a bullish trend, meaning we are breaking above highs and rejecting below lows. And then what happens is that this low right here breaks above this high, and not only that, but it also tests a higher time frame key level. So now if the higher time frame objective has been met and you're looking for a structural shift, then the way how you'll anticipate that is by waiting for this low to be broken and closed below. The reason I chose this particular low is because this was the exact low that broke this high, and this exact low led price to test a key level, a higher time frame key level, which means this is the significant low, and when it's broken below, structure will change. And you can see price came down below, broke below it, and after that point right here, we've shifted the structure to bearish. Again, right here you can see the same framework. When a bullish trend, and then right here this low breaks above these highs and also test a key level after this low. So this is a significant low for us, which we'll look for to be broken to anticipate a structural shift towards the bearish side or downside, right? And after this exact particular low is broken, it will result in a downtrend, right? This is how we identify or classify a correct structural shift. Now moving on, here we'll discuss how we're going to confirm a bullish structural shift, right? Again, will you be using the same logical framework but in the opposite direction? The whole core concept remains the same, right? When a high that breaks a low and leads price to test a key level is broken, that structure changes and shifts to bullish. Let's look at it right here. So again, price is in a downtrend because it's breaking lows and rejecting highs. And then right here, it tests a key level, and this key level is tested with this swing high, this swing or expansion right here. And this swing originates from this high, and this high not only let price to test a key level, but also broke this low right here. So that means this has a significant key level, and when this has broken up, a structural shift will occur, and structure will be changed and it will shift to bullish. So let's look at some examples right here. So this is the first example we've got. Right here you can see that the drawn liquidity is higher, which is this range high right here. We started this bullish trend right from here when price tested this key level, and you can see we are moving higher in a fashion where price is repeatedly breaking above highs and is only able to reject below lows. This classifies this structure as an uptrend or bullish market structure. You can see this low is rejected right here and immediately price expands above. You can see that all of these rejection below these lows are short-lived and price isn't able to stay below them because the structure is bullish. This is how rejection below low looks. You can see that right here price even closed below it, but it doesn't mean it broke it, right? It broke below this low, because breaking low is when price displays lower and expands with a big bulky candle, and not only that, it also continues going lower and isn't short-lived. But in this case right here, you can see that even though price closed below it, it immediately went above and expanded higher, and that closing below that low was short-lived and price did not stay there for a while. This is what we call a rejection below a low. Rejection below low can also look like this, where price just wick below lows instead of closing below them, right? Whereas if you look at the highs, you can see that price is clearly breaking above highs by not only closing above them but also staying there for quite some time, which suggests breaking instead of rejection. And rejection below lows or above highs, the price can close, but it then reverses immediately. But in case of breaking, it not only closes but also at the same time it stays there for a while, which suggests breaking of highs or lows, right? This is how you classify rejecting and breaking of highs and lows. This isn't subjected to just closing of candles, but also how much time does price stay there for, right? You have to comparatively weigh them both, and you're going to see that if the structure is bullish, then when price closes below lows, it only stays there for a while, for short term, for short amount of time, and then it expands and reverses immediately. Whereas in terms of when it comes to highs, it closes above those highs, and not only that, but it also displays above those highs and stay there for a while, which suggests that the high have been broken instead of rejected, right? Moving on, right here you can see that as soon as price took out this low, it started this bullish trend towards the higher time frame drawn liquidity, which is high. You can see that price is clearly rejecting lows and breaking above highs, which suggests an uptrend and a bullish momentum. A strong uptrend is where price is not only consistently breaking highs but also rejecting lows, just as shown right here. Right here you can see an example of a downtrend or a bearish advanced market structure. Price is consistently rejecting highs and breaking below lows, which suggests a bearish momentum, and price is maintaining that bearish structure until and unless a higher time frame drawn liquidity is reached. In that case, the structure would be shifted, right? Here is an example of a bullish structure shift and how you can correctly identify it, right? You can see right here that this high or this short-term high led to price taking out this low or short-term low, and not only that, but with that, but with this swing, price also tested a higher time frame key level. So you can see that this short-term high right here is a significant high or short-term high, and we would look for it to be broken, which will confirm that now a bullish structure shift has occurred and a bullish structure has started and the trend has shifted to an uptrend, right? Another thing you can also see right here is that this low right here is an intermediate term low. This can also be classified as a long-term low because it tested a higher time frame key level, but you can just classify it as a intermediate term low. And the reason for it being an intermediate term low is because it has two short-term lows to its opposite side, one to its left and one to its right, and then this intermediate low is protected, which means the only reason price is going to start the uptrend and the uptrend is going to stay intact and it is going to continue if this low is protected and price doesn't break or reject below it. And you can see it stays protected and price starts its journey higher towards the drawn liquidity in a fashion where it's rejecting below only short-term lows and the intermediate term lows are protected and it's breaking above highs, right? Here is an example of a bearish structural shift. This exact low or short-term low led price to taking out this high, and not only that, but this also, this low also originated this swing, which tested a higher time frame key level, right? So based on these two criteria, this is a significant low. And if price breaks below this low, the structure would be changed to bearish. Once price breaks below it, the structure shifts to bearish, right? Because this low follows two criteria. First of all, it broke above a high, and second of all, it originated a swing which led price to testing a higher time frame key level. So this means that this low is significant, and if price breaks below this low, the structure would be changed to bearish. Here is another example of a bullish structural shift, right? This high broke this low and tested a key level. So you can see this high follows the two criteria for a bullish structural shift. First of all, it broke below this low, but not only that, it also tested a key level. So that means this high is significant. And when price closes above this high, the structure will be changed to bullish and we will start an uptrend. And you can see right here that price closed above here, the structure changed, and then price continued that uptrend by rejecting lows and breaking above highs. You can see it right here. You can also see that this, you can also see the intermediate term low and the short term lows right here. It's a homework for you to tell me why is this low an intermediate term low and what classify it as an intermediate term low, right? This is a homework for you and you have to tell me that. Let's move on to the next slide and let's discuss some important points regarding advanced market structure. First of all, again, as I said before, it's used as a conference. I've said that multiple times and I'm going to say it again because I don't want you to use it alone, but instead you should use it in conjunction with the other concepts, right? It must never be used as the main basis, which means you should never start analyzing price right away with this, right? But instead you should only use it later once you've already established and built a narrative and you want to gain conviction in that narrative or that framework or that trade idea, right? It's used to gain a refined perspective into the structural aspect of the charts and prices, right? Last but not least, you're only going to use the advanced market structure in methods that I've shown you throughout the chapter instead of the basic ones because those ones don't work. The only ones that work and that work accurately is the advanced market structure that I've shared with you throughout the chapter. Last point about market structure is that you should only be using it for your higher time frame. Now it's up to you what is your higher time frame based on your time frame selection and time frame element, but you need to remember only higher time frame, right? As I'm an intraday trader, that's why I only use it for the 4-hour time frame. Similarly, if you are a swing trader, then you should only use it on the daily or the weekly time frame depending upon your time frame element and time frame selection, right? You should never use it for your lower time frames or intermediate time frames, but only for your higher time frames, because then that create confusion and noise and create just useless or worthless distraction for you, right? So only use it for your higher time frame.